Welcome, everyone. We have a very, very interesting program for you today, and I hope it will be also very profitable. Our outline is we're going to give you a bunch of strategies. We spend a lot of time on gold and silver because that's an area that I've become expert at. We're going to give you some financial astrology, which I think has been quite accurate last year, and I think it will be just as accurate going forward, and then some very special situations. We also have very short 4 to 5 minute presentations by 5 companies that we like, and we hope some or more than one will be of interest to you, and if so, go visit their website and see if it's an appropriate investment for you. First is the usual disclaimer that you should do your own due diligence. Just because I buy something, that doesn't mean you should buy something. But what we usually ask is if you make oodles and oodles of money and you make billions of dollars on my recommendations, that you send me a nice bottle of champagne from my cellar. On the other hand, if it turns out you lose money because of a suggestion from me, you may find that I don't respond to you, and I say, who are you again? No, very seriously, obviously do some due diligence on anything that we suggest. We're just going to give you a lot of ideas. In terms of housekeeping, we have lots and lots of material to cover. So what I will do is post this probably tomorrow on our YouTube account, so that way you can review it if you wish, and you don't have to take notes. Additionally, you may want to invite colleagues and friends. And if you have any questions and answers, we put them at the end. We have a chat box. Put it in there as well. Now, basically, I'm a cosmic value investor. That means I like to buy undervalued stocks, and I like to time it, because obviously stocks go up and down, and I prefer to buy them when they're down and sell them when they're up. When people ask me what my system is, I mean, the real answer is, of course, that I do, when I invest, I do fundamentals in astrology, and when I trade, I do technicals in astrology. But since we're talking about investing here, we always like to say that we're students of Will Rogers, who was a very famous humorist in the 1930s. And he had a philosophy of investing that I recommend to everyone. And what was that investment? He only wanted to buy stocks that went up. So this is what we're going to recommend to you. And in order to do that, you obviously have to buy at the right time. However, basically your own portfolio should reflect who you are. I consider it like wearing clothes. Your style of investment may be different from mine. We're going to give you a lot of ideas, and hopefully some of them will be profitable for you. I think it will be interesting, but the important thing is it's profitable. And clearly 2 things are going on. We have very volatile markets, as we saw this last week, in the last couple of days. So we also want to invest for that, but we also want to look at the long term. So there's 2 things we're dealing with: long-term investing and very short-term volatility. Right now, the majority of investment houses are extremely bullish, at least 10%. So the question that you may have, or at least that I have, is when will U.S. markets euphoria end? Will there simply be a 10% continuation rally, which is most of the big banks? There's a quote that by Talley, I would love to see a meaningful pullback in equities. And I want to say, so would I. So we've identified 3+ times in 2025 that we think that can happen. And we'll share it with you before we go into some details. On the 17th and the 16th, we have a YouTube account, we have a Twitter account, and the first trade was basically between the 17th and 21st. We already had that, as you know. The market went down very nicely. That was our first trade. We're still in that trade, but trading around that trade. The second time is on the year end, which is either the beginning of the year or next week, and then or January 25th, that is to say after the presidential change. And then we have a time in June. So these are the three times. We're in the process of one of these. We always had a good trade, took some profits. We're still in it. There's a second time and a third time. We'll go into some detail. So this was very profitable. And there's a lot to go ahead. So what's my view of 2025 going to 26? Whether we're going to be a W or an M. We don't see a straight line. If you look at the charts for this year, it's almost a straight line up. But we think we're going to see either a W or we're going to see an M. So we're going to play. Will it be a 5% pullback, a 10%, 20%, 30%? This is open. The big issue, both for the United States and the world, is there's a lot of debt out there. And it has to be dealt with in some way. One of the issues that the president or the president-elect wanted to do was get rid of the debt for 4 years, which I find very surprising. I tend to agree a lot of what President-elect Trump wants to do, but the idea of getting rid of the debt ceiling was definitely not one of the things I would recommend. And globally, we also have well over 100 trillion. Somewhere in the next 2 years, or I would say actually within the next 19 months, we're going to have a bear market. And we'll talk about when it's likely to be, and we'll be positioned for it. I don't think we'll see it right away for a number of reasons, but we're certainly going to see it, I think. So you have to position yourself, if you agree with me, to allow for that possibility and to make it profitable. There are many market negatives, and by the way, this list could be longer. I'm sure you can agree. And it's everything from high deficits to potential tariff and trade wars, which of course is a big one. Labor market softening, but the big one, high valuations, but the big one is that there'll be a global recession. Now, this may be ex-U.S. We'll talk about that in a moment. So the U.S. may not have the same issues, although it may, but there is a very high probability of global recessions. So the other interesting thing is just recently Bank of America pointed out that the cash holdings of asset managers are the lowest in 13 years. That obviously is negative if you don't have money to buy in the future. Now, markets are way up. Whether money comes in March and April, we'll see. But at the moment, there are a number of negatives, but we could add to them, which means at certain times in the next 2 years, one or more of these will go on the trading screen and what people will be worried about and when they'll sell. And, of course, the usual black and white swan events. Last year, we had 4 big known unknowns. The first was what the Fed was going to do. Almost everybody said, of the big banks, that there'd be 6. We disagreed strongly and said there'd be 2 or 3. Turns out there were 3. Excuse me a moment. The next thing is the Ukraine and Israeli wars, which certainly affected the price of gold at times. And we'll talk about how and why it did and what to do about it. Then there was the BRIC dollar alternatives and the U.S. presidential election, which turned out to be a very big positive. So these were the 4 things that we were concentrating but didn't know as much about. So what are the 4 big unknowns? The Fed again. Everyone now, the Fed has gone down to 2 views. I think it's anywhere from 0 to 3. We don't have a view yet, so we're not saying it, but it's somewhere between 0 and 3. The Ukraine and Israeli situation, which I think will end up rather well, but there are other geopolitical risks which we have with both China and Russia and others in the world. Now, the BRIC de-dollarization is in effect, and it's affecting maybe 5, eventually 10% of the global economy for the U.S. dollar, but it's not going to be the devastating. There'll be no BRIC currency that we have to worry about. So the U.S. dollar will still be major, still be over 50% of the world. This will be a factor, but it will not be a major factor. And, of course, we have a new factor, which is Donald Trump, which is extremely positive for the markets. So FOMC meetings, every one of them will be an issue. The January 29th, the consensus is that the Fed will not lower rates again then because it's too soon. We tend to agree with that, but we don't have views yet of the rest. So we agree with the consensus the Fed will not lower January 29th. This is interesting because there's going to be some more bond volatility than people are talking about. Economists are still predicting a soft landing ahead in the United States. What we had last year, which was stagflation light, will be a little more recessionary with some deflation, but there's a possible U.S. exception. We're going to talk about that. There'll still be pockets of stubborn inflation, certainly in terms of labor costs, and there'll be certainly more labor strife, more shrinkflation, more discounting, but this is going to be the big thing that's going to affect bonds. Tiered dynamic pricing. What does that mean? For the same item, some people are going to buy it a lot cheaper than others. We know with dynamic pricing, it goes up at times because of demand, and tiered because of who you are. So depending on what the bond market is looking at and what the Fed is looking at, are they going to be using the discounted prices? Probably, to show there's not high pricing, but there's plenty of times the pricing would be much higher. So that is a reason we think there'll be some bond volatility and why we can't decide yet between 0 and 3, which means that you can trade it well. And we give those type of trades usually extreme points and on our Twitter and Telegram accounts. Now, this is the big news. I think everybody, whether you wanted the election to go that way or not, it's a fact. And this is the most important point. Trump is the most pro-stock market president in history. He measured his success by how well the stock market did. And as he said, it's very, very unlikely he's going to implement policies that are going to be bad for the stock market. Highly unlikely. So basically what you want to look at are 3 times. November 4th, where the market was just before the election. And of course, went straight up. December 31st is what we normally look at because it's the beginning of the year, but January 19th. And that's whether Trump will be looking more at November 4th or January 19th is to be determined. But these are some very important technical points outside the 50 moving day average, the 200 moving average. These are important to Trump personally. We haven't discussed it with him personally, by the way, but we know this is what's going on. So the November 4th targets and January 19th, as well as December 31st, those are going to be very important buy and sell points, support and resistance. So do keep track of them. We will as well. So why is Trump so positive? Because he wants less regulation and taxes. U.S. equity funds in November were almost $140 billion, the highest recorded from 2000, because of investor optimism towards Trump pro-growth policies. Again, tax cuts and deregulation. Now, clearly, if I speak to anyone who is positive about the market, I'm not so positive, the main thing they mention is Trump. Whether or not they voted for him, whether they didn't vote for him, they know he's good for the market. So that's the number one. But what else is there? Well, there'll be more deal-making in M&A, again, because of less regulation. What's critical, and this is open for debate, is just this month, after several years, the LEI trend has changed. It's gone positive from being negative. That is a very positive fact. It takes about 6 months to be in effect, but it may or may not be continuous. We're going to watch this over the next 2 months where that trend change remains positive. I'm questioning it. Clearly, we think there'll be a Ukraine ceasefire very close to whether it will be this month or whether it will be January 20th. We think certainly within 30 days we will see a ceasefire, which is a positive, but a bit of a negative for gold. AI and quantum euphoria. I think the AI will continue. Quantum, I mean, some of these stocks went up 5-6 times in December. We were watching them, didn't play it, but watching them. I don't think they're going to go up 6 times again this year, but they'll stay there. But this is the main thing. U.S. exceptionalism. Basically, the U.S. is sucking money from the rest of the world at the moment. A lot of foreign money is trying to come into the U.S. The U.S. is trying to block it. It's blocking the Chinese money, it's blocking the Russian money, and elsewhere. But it wants to come in, and that's a very big positive for the U.S. markets. So what is our basic approach? Again, we're giving our overview before we get into details. Number one, we think there are physical and economic challenges in the next years. We think this both for fundamental and astrological reasons. So as usual, we're cautious. We are basically value investors, not momentum investors. That doesn't mean you can't make money in other ways, but we're cautious. The most important thing is to have the ability to buy if and when markets panic. You must have cash available or you must have margin available. If you're the type of person that's been very heavily margined, somewhere in the next year and a half, we'll talk about when this can be, you're going to be in deep doo-doo. Think about October 22, which we were well positioned for. So again, there'll be winners and losers. And in general, good stock picking outperforms index funds, although index funds have done very well. 25% is not a bad return for the year to date. So this is very critical. Fundamentals do not matter until they do. So we're going to give you our valuations. Let's start with gold. We'll go into detail why this is so. We think gold's worth about $22.70, which means gold's highly overvalued. But stocks and commodities can stay highly overvalued for multiple years. For many years, gold and silver, for example, was highly undervalued. So it's not an exact thing, but for someone like myself, it's very important. Silver is worth about 26 to 28. It's slightly overvalued. Copper has two sets of valuations. Because we think we're going into a global recession scenario, we think it's going to be closer to the 380 again. We got the 380, the 360 last year, and eventually then we'll go to 460. So we think it's going to be going down, not up. Oil has a number of factors going on, the Middle East being part of it. But in general, we think it's in a range of about 68 to 78, because obviously U.S. oil production is going up this year. So that's going to be a sort of negative for the market. And I do think potentially the Middle East, if we don't blow up, which of course changes that, will keep this subdued. Bonds, we've been trading back and forth. We're roughly in the 440 to 460 area, because for a large period of time, I believe we'll have that stubborn inflation. Eventually, we may go down to 370, depending on what happens fundamentally over the next year. Now, I believe the S&P and NASDAQ are wildly overvalued, but that doesn't matter because they've been overvalued for quite a while and they will stay that way. But that's why I do certain things that we'll be talking about. Eventually, fundamentals matter, and that means within the next 18 months. So our philosophy is how to survive and thrive. As always, it's a stock picker's market and a trader's market. We like gold. I'm a Leo, so obviously I'm a gold person. And we like it both as an investment, as a hedge. We definitely like stress and distress and M&A, and there'll be a lot of it. We don't think we're at the end of it, for example, in commercial real estate, but there are other areas as well. Now, there are definitely U.S. presidential winners and losers. For example, in energy, obviously, oil and natural gas will be more favorable, and obviously clean energy subsidies will be less than they would otherwise. As for losers, certainly we see some in healthcare in the biotech area. Certainly companies like Moderna are not going to be as happy as they would have been alternately, but we do like the biotech sector in certain cases. And obviously vaccine makers are not going to be as profitable. We still like hard asset inflation protection. We like dividends, because again, I'm cautious. Always, you must like profitable companies with pricing power, although they may not give you the biggest returns. They're the safest, and special situations are 100% what we like. So, BMO mentioned how gold will do very well, even more than silver, and we'll talk about why we agree large extent. So what is our gold view? And then we're going to be going to a lot of detail. We have a lot of material to cover. Our gold view is we like gold and precious metals for both investment and as a portfolio hedge. Traditionally, it was about 5%. I think 10% is a little bit more appropriate now. If you want to do, you can go up to 20% for a portfolio hedge. And for companies, and almost none of them are doing this, but if I were a gold or silver company, I'd be hedging about 20% on my production. If you're pair trading, which we like to do, up to 50%. Now, if gold is strong because of a weak U.S. dollar, right now we have an extremely strong U.S. dollar, whether it's as strong next year is a different story, then small and micro caps tend to outperform. If gold is strong due to a crisis, then gold as well as large caps will tend to outperform. Basically, if you're conservative as I am, you have no trouble with $2,500 gold and $30 silver. If you're more aggressive, then you believe at least it should be $3,000 or $40. That's not our play. So what I'm going to do before we go into lots of detail is we have a number of sponsors. We have short 4 to 5 minute presentations. I think most of these are very interesting companies. If you like them, then I recommend going to their website, watching their full presentation, and sign up for investor updates, add it to your investing and trading screens, and of course, none of them would mind if you buy them. So we have 2 of them coming up, and then we'll continue. Sorry for that, folks. I forgot to introduce them. Okay. The first pitch, by the way, is from EMX Royalty. There are 4 reasons we like this company. The first is it's a royalty model, which is a very safe way to play precious metals. The second, they have a large, diversified global portfolio. The third, they're very unique. It's that they not only acquire royalties, but they create them, and they have a major partnership with Franco-Nevada.
Hi, everyone. Special thanks to Henry for putting this on. I'm Dave Cole, the CEO, co-founder of EMX Royalty Corporation. We believe that mineral rights are dear assets that we want to be exposed to, and the best way to be exposed to mineral rights is through royalty ownership. And I'm going to walk you through quickly our portfolio. I'll also speak briefly about our methodology for accumulating royalties around the world, which now our total mineral right footprint on the planet is over 4 million acres. We generate royalties organically by acquiring mineral properties, coalescing data, illustrating prospectiveness, selling those assets, and keeping royalties. We also buy royalties to augment that portfolio, and we've done both quite successfully. Those 2 models integrate together in a very synergistic manner, enabling us to accumulate royalties quite inexpensively. 6 producing royalties, Leeville in Nevada, gold, 4 million a year plus. Caserones, copper and molybdenum in Chile, 10 million a year plus. And then the very important Timok project in Serbia is a nice paying royalty for us with immense long-term potential. I'm going to go into a little bit more detail about that here in a minute. Balya, lead, zinc, silver, paying a little over $1 million per annum to us. Gediktepe is currently a gold-silver deposit that will evolve into a copper-zinc gold-silver deposit as they move into the sulfide zone. And all of this speaks to this concept of optionality, being exposed to these mineral rights, having other people spend the money to advance them, to pay for the exploratory drilling, mine development, and gives us that ability of what we call in the industry optionality, where discoveries are being made and mine development and infrastructure is being put in, all creating value and upside for us at no cost to us. And this portfolio has been specifically designed to capture that optionality. And this has resulted in a portfolio that has had substantial increase in top-line revenues coming into the company and cash flow coming to the bottom line. And I'll point out that that is coming from 6 producing assets in addition to property agreement payments and other payments that we have as those assets are advanced. And it's coming from a nice diversity of copper, gold, lead, zinc, silver, and molybdenum. Very importantly, I'd like to get in and discuss what is probably the most valuable royalty positions within the company. Those are our positions in the Timok complex of Serbia. Historically, Europe's largest copper and gold producing region and one of the larger copper gold development stories in the world today, being advanced by Zijin, a total capital expenditure of likely over $5 billion per their memorandum of understanding with the Serbian government and past expenditures. And this is advancing some upper high-grade zones and then an immense large porphyry copper gold system at depth in addition to some new discoveries. This royalty has already paid $12 million to date, over 12 in fact. Is paying around 1.2 to 1.5 per quarter at this point in time, whilst they're mining in the upper zone. They just announced increase in mill capacity there. We're pleased about that. And they're doing the development work to advance the huge deposit at depth, which is over 2.5 billion tons of 0.76% copper and 0.16 grams per ton gold. This is an immense deposit. It represents immense long-term value to the EMX shareholders as we will scrape our royalty off the top over time. And then I've talked about discovery optionality. This is a phenomenal example, but the MG zone has been alluded to in the last Zijin quarterly report. They said that they will announce the discovery in the next quarter. There's, from our inspection of the satellite imagery, we see 12 drill rigs turning within our royalty footprint. Zijin said that this is a high-grade and large deposit. Just a great example of why you want to own royalties, be exposed to royalty portfolios. And I believe that when you dig in, you'll find EMX Royalty Corporation to be a great candidate to put into your portfolio. We are always available for questions and further explanation about our assets, about our business model, etc. You can reach out to us. Our information is on our website, emxroyalty.com. And thank you very much again to Henry. I wish you guys a good conference.
Okay, that's one company. Maybe you can understand why we like it. Now here's something a little different. It's a brand new company that we just took a look at. It's called Fairchild Gold. And there are going to be at least 4 reasons we think this is of great interest. The first, it's hiding in plain sight. I love that term that he came up with. Their main copper project is 45 minutes drive from Las Vegas. And you've got everything you need there. It's an excellent jurisdiction and location. They also have another property up in Canada that's the same thing. One of the reasons I like this is it's copper and gold. And what does that mean? Well, copper tends to do better in good times, and gold tends to do better in bad times. So you have a sort of natural edge here. Their relationship, one of the ones, if they happen to have a relationship with EMX, which is one of the reasons we put them right afterwards, and it's sort of a very new early stage, which means it's very high risk, but you make the most money very early on and very later at the end, just before you're going into production as a mine, and also the early investors. This is a very early play, obviously high risk, but very high reward as well if it's successful. So we're going to hear this in just a moment.
I work for Fairchild Gold. I'm the project geologist, Aaron McBriarty. We're looking for a porphyry system. Fairchild Gold is an old gold company that's now leaning towards copper. We're listed on the TSX Venture FAIR. There's been a whole bunch of different mines on the project that they've been dug down about 50 feet to 100 feet, and they've been looking for gold and copper and platinum and palladium.
In the last 2 years, we searched for a significant project, I would say a little bit around the world. We have been in South America, we have been in Africa, evaluating several projects, but we never had the opportunity to look at one project that has a good geology, a mining potential, but at the same time, a very good infrastructure and an excellent location. And Copperschiff has exactly that. I mean, you have all the infrastructure in place, energy, water, very good access, and better than everything, we are in the best mining jurisdiction of the world, Nevada, and just 1 hour driving from Las Vegas.
This is southern Nevada. We're about 45 minutes from the Strip of Las Vegas. You know, we have road access up to the project. We have power up to the project. When I say up to the project, I mean it's right there. We've got, you know, plenty of access to whatever we need from the airport. That mountain's got about 10, and that mountain has about 7 or 8. And then there's more on the other side. And all of them have been mined for gold and copper, and there's something in the plumbing underneath it that brings it all together, and that's what we're here to find out.
I think it's important. We all know the importance of gold, but today we have a lot of critical and strategical metals a little bit around the world, in the US, in Canada, in Australia, in Europe. For instance, nickel, cobalt, magnesium, lithium, all of them are strategical and critical. But I would say that the most critical one, essential for the decarbonization, for the electrification that we are facing today due to the energetic transition, it's copper. So we are going to consume a lot more copper that we have consumed until now. So copper will be, I would say, the king of the strategical and critical metals because of that. We are just scratching the surface with new mineral zones being identified and evidence of a large-scale hydrothermal system. We believe that this project has a big potential to grow in the multi-year large-scale operation. Ongoing exploration, that the next steps that we will develop in the project will help us defining the full extent of this opportunity.
The platinum and palladium are a big bonus as well, right? Because, you know, the platinum palladium numbers are very, very good. They're almost 1 part per million or 1 gram per ton. In terms of the porphyry is one thing, but we have platinum palladium deposits in the rocks that is another avenue of revenue, right? So it's just a bonus on top of the copper, right?
Yeah, you are completely right, Aaron, and thank you for highlighting that. If we succeed with this strategy in our Copper Chief property, this will become the flagship project for the company, and for sure delivering significant value to the shareholders. It has the potential to host a major copper gold deposit, a copper gold porphyry, high tonnage, maybe low grade. This is common in the best mines in the world with this type of deposits, and this which would attract further investment and partnerships. Our vision is to develop the property in a sustainable mining operation and contributing to the growing demand for copper and gold globally.
Okay, I think those are two interesting stories. You should put them on your watch screen, or better, if you do some due diligence on it. Okay, let's go. We've got a lot more material and a lot of specifics. So what's the big picture? This is number one. There's a global recession coming over the next year and a half. Whether it includes the United States or not is a different story, and also when it's acknowledged. But it is coming. You know, it doesn't matter what the truth is. It matters what people think the truth is. At the moment, they're acting as if we have only 2% inflation, which of course is not the case, and that there's growth, because obviously they're confusing growth and inflation. So there are many ways to deal with it. The three areas that I like dealing with, and again, there are alternate ways to play this, is gold, entertainment, and cash. This is for the recession part. Obviously, things like defense and other AI, etc., meet other reasons. But if we do have a global slowdown, or if we acknowledge we have one, then these are three items. Now, here's something a little different than you normally hear. We believe that at 26 to 2800 gold, which is where we are, and at 34 to 38 silver, we were at silver at 34, and we went down to below 30, that one should sell some, not all, gold and silver physical, and buy gold and silver stocks. Now, a lot of people disagree with this, but we think we're right. That is to say, you get a better risk-reward return by selling a certain percentage, we'll talk about that later, of gold and silver at those targets, and then converting it to some gold and silver stocks. Now, classically, gold and silver stocks outperformed gold and silver. That is to say, when gold and silver went up, you got an extra benefit from buying the stocks. Now, this has not been the case in the last few years, since the days of, shall we say, the alternatives that you could buy gold to, such as with Bitcoin. However, we believe that along with increased M&A, that is to say, from gold and silver stocks, the big guys buying the little ones, that this will be in the cards for next year. Okay, technical analysis, you know all this. Basically, you just pay attention to the 50-day and the 200-day, which is basically on the S&P, being the 6,000 area, which is where we were doing a lot of shorting or writing calls. And for the 200-day, that is to say, the big boys, as long as we're above 5,500, they don't care. If they come in at 4,500, 5,000, they're not going to get concerned. Once these are broken, people get concerned. So here's some astrology now. There's 5 big points. Number 1, the U.S. Pluto return, the rebirth. We believe, and you didn't need to be an astrologer to know this, that roughly from the year 2020 to 2022 till basically 26 and so forth, there is a regeneration obviously you can tell a little bit about what my politics are. But in a year and a half to 2 years, this regeneration, this challenge, this mega versus woke, if you'd like, on the extreme, although there's plenty in the middle, is happening. And we think by the end of 2 years, more classical, original views of America will become more mainstream. That's an astrological field. Obviously, Pluto going into Aquarius has a lot to do with what we're seeing in the Aquarian, whether it be the AI, whether it be space, and we've talked about that for the years. But now let's get a little specific. There are 3 items that are critical. The first is the Jupiter-Saturn square. And we said at the beginning of last year that the markets, and by the way, these dating is not the exact dates that it shows in the markets. It can be within a month or 2 of this, and that you need to pay attention. First, that around August, and both at the beginning and the end we gave it, the markets will go down, which they did. Then we see in December, we've already had one downtime, and we think there'll be another, whether it be the beginning of January or next week, but we had that down period. And there's another time coming in June. Then we're going to talk about the Saturn-Neptune, which is the big play, and then the solar eclipse. So far, on the big astrology, which we've talked about, we've already gotten 2 trades. Now, it didn't stick, which is why we have to trade it, but they were certainly good trades. So let's talk about Jupiter-Saturn. Those are the classic business patterns, and we said that around those times, and we've already had it. But whether or not people will take profit at the beginning of January, which is very possible, in the first 10 days, because of the lofty valuation, or whether they're going to wait till summer, we don't know. We already had one down move, there's probably another one coming short term, but the bigger one is coming in the summer. Last year was the first year in many years that we didn't sell in May and go away. That was the reasons we gave astrologically. This year, again, we'll be selling in May and going away, which means you can just deal with it after tax time. So this is the big newbie. The Saturn-Neptune is called rock on a cloud. This will be near exact in next summer and exact in the winter. First of all, for non-astrologers, let me give 2 examples. The fall of the Berlin Wall. Think about a rock on a cloud. What's going to happen? And for those of you in the markets, we called the Bre-X disaster 2 weeks before it got our clients out because of that spectacular collapse. That was a Saturn-Neptune. That's a flavor of what's happening. Now, the fact it's not exact means that in this next year, there'll be places where it will happen. It may or may not happen in the United States, but it will happen even in the United States by the winter of 26. So we're preparing for that. It's a very biggie. And for those of you that are astrologers in the audience, which is not the majority, note that Saturn-Neptune is taking place at the 0 Aries point, which means it will manifest on the physical plane. So we're going to see some black rocks on a cloud. No question about it. So we have high recession odds by summer, but higher still winter of 26. How much of this will be shown in markets, we don't know. So it may be just a factor in the market in 25, but it will definitely be there. And by this we mean negative GDP. For some reason, only in Japan and England last time, when it was negative GDP, it was a recession. In the U.S., we had 2 negative quarters, and it wasn't a recession. So I can't say what BLS is going to say, but we'll be in a recession. We're preparing for it. And the total eclipse is for next year. We don't have to deal with it now. There's some dramatic things. Next, country focus. North America. Well, first, of course, we like the U.S., and so does everyone else putting their money here, basically due to Trump. Canada, we like. Now, right now, everyone is down on Canada. That's why we love it. We like buying dirt cheap. We like to buy low and sell high. Why do we like Canada next year? Well, the astrology. It's a very, very cheap currency. It's got resource advantages. And the politics are about to blow up. So once we get rid of the current prime minister, then I think it will be better. So it may take a few months. So Canada, and of course, since we're in mining a lot, we're doing a lot in Canada. Argentina, we've loved. Melee's done a great job. If you've been in it now for the last year, you've made a lot of money, and a lot more money coming in the next year. And Israel is also, very interestingly, could be some major plays coming in there as well. But that's still on the watch list. So our focus, of course, will be mostly domestic. And, whoops, sorry about that. Canada and Argentina. So there are a couple of places there. Now, gold does well in geopolitical tensions. And given Trump, one of the reasons it went down when he was elected is because he was about to solve a number of problems in the Ukraine. He, I think, was sabotaged from that. But that's a partial issue. So, wait a second. I'm missing something here about the gold. One moment, please. Oh, I didn't say something. How did I skip this? Somehow I skipped. I didn't deal with the fair value. So I'm jumping in this. The gold fair value for me is $22.70. If we look at it as a commodity, as a currency, as inflation, as a crisis, it's 28. So the reason it's so elevated is because of the world crises. As the world crises at times get apparently solved, then gold drops a lot. And of course, we talked about silver, and it's closer to its valuation. So just going back to here, I don't know how I must have jumped that, but effectively, if we look at Trump, there are three facts about Trump that are inconvertible. Number one, he loves the stock market as a measure. Number two, next year, whether you like him or not, he's going to be the most powerful man in the world. And number three, he's going to be in many fights, certainly domestically, possibly internationally. But certainly there'll be political. But his goal, at least internationally, is to solve them. And when that happens, gold will be dropping. But this is my view. Even if gold and silver drop 10 to 20%, good gold and silver stocks are deep value. So we think buying some of these stocks at the right price and time over the next 2 years will outperform just physically holding gold and silver. And we're not saying not to hold it, but you should be owning some of these stocks. So if we talk about the big ones, the ones that give you the safest buys and some upside, there are four that we like, that is to say in the billion-dollar range. Agnico Eagle, which is probably, I think, the single best-run gold company out there. DRD Gold, which we've introduced before, and that is if you're interested in cleaning up the environment, if you're interested in gold, if you have an interest and concern, which I don't think you should today in most cases, although there are issues of gold mining problems, DRD Gold cleans up the environment and makes you a lot of money. Kinross is something we just put on the list. We just met with the management over breakfast recently. We decided that they belong on our buy list. And Wheaton Precious Metals, we do believe in royalties, and Wheaton is one of the best. So if you want something that's very safe and you're a large player, Agnico Eagle, DRD Gold, Kinross, and Wheaton. If you want to have more reward but with more risk, EMX Royalty, which we've introduced to you. O3 Mining now was just bought out at a good 50% premium. So if you have that, there's nothing wrong with being bought out. You got a lot of money. Another royalty, our third royalty that we like is Vox Royalty and Step Gold, which is a good one. Then for the very, very small plays, and these are actually well under 100 million, Gold Terra, which we'll be introducing to you, PT Gold, and Soma Gold. So these are higher risk reward, but certainly you should watch and you can make some money on them as well. We tend to like the higher risk reward. Now, this is our watch list. You don't need to know it, but the point is I'm a Leo. I like gold, and there's a lot of stocks we're looking to, and we occasionally move them up and down. Silver. We like silver as well. Mag Silver, which we'll talk about later, which was our desert island pick. Vizilla Silver, and Silver One. All three of those are good buys for next year. We think they'll return equal or greater than the S&P. When we get to copper and base metals, Adventus was one of our picks, was bought out as well. I think that's a positive. Calinex, Kodiak, and the Metals Company. So there's a whole series of companies you can look at if you've got the time and interest. So now we're going to present two companies in a little bit of detail, and then we have a lot more information, and then we'll deal with Q&A if there's some. Goldterra is a company we produced before. There are a number of reasons. It's basically under 5 cents, so the most you can lose is a nickel. Got very good management. They've done it before. It's in the right location, and he'll give you some reasons. So if you want to have something with a sort of high risk, high reward, where you're going for a home run, at least for a 4-bagger, this is one that you can have. And if I'm wrong, the most you're going to lose is a nickel.
Hi, my name is Gérald Paneton, Chairman, CEO of Goldterra Resource Corporation. We're busy working on the Yellowknife high-grade camp, and I'd like to talk a bit more about it and why you should be paying attention to Goldterra and buying as much as you can. It's a very simple project. It's located in Canada in the Northwest Territory. It has access, it has infrastructures, it has a very good support for many shareholders that we have accumulated over the last 3-4 years. Very good support. Again, we just finished raising money for our program in 2025. But why buying Goldterra is very simple. It's a very focused strategy on high-grade mineralization in Canada. Tier 1 with infrastructures. The Campbell Shear, this is where you find gold. You find gold where gold was produced. 14 million ounces at 14 to 22 grams, a Canadian asset, a district scale, 70 kilometers of the Campbell Shear, very underexplored for the last 20 years. And of course, lots of infrastructure, from hydropower to airport to a town of 20,000 people. And the option we did with Newmont, the big Newmont, an option to purchase 100% of the Con mine, where 600,000 ounces were left in the mine when it was shut down in 2003. But what's very important is also about the location of the project. It's, like I said, it's in town, but it also has a tremendous potential. The Campbell Shear was mined over less than 5 miles. So you can imagine the potential over 50 miles. I'm not saying we're going to be finding 10 more of those, but there's a reason why you want to buy into Goldterra. The valuation is less than $10 an ounce. The potential is huge. We can probably walk away years later with many ounces available in our reserve. And why did we choose the Con mine? It's because of its property. It's got a mining lease, surface rights, and 600,000 ounces. And already in our earlier few years of the option with Newmont, we've outlined 500,000 ounces. And we're planning in 2024 to keep drilling at depth and, of course, at surface, between surface and 700 meters vertical, a drill program. The Con mine produced 5 million ounces of gold. And when you look at the property itself, it's very clear to me that with the town in the background, the asset, the brownfield, the road, the power lines, the water treatment plant, the settling pond, there's a lot of value in the Con mine. But the biggest value is probably on the permitting process. Because it's a brownfield industrial site, already been disturbed, the permitting process is very different than the brand new projects, which save a lot of time. And with the existing infrastructure on the mine site, you save a lot of money. Don't have to build road, don't have to build ditches. Settling pond is there. and of course the water treatment plant and things. But going back to, you still need to find enough gold to put it back in production. This is our goal. We want to find enough gold. We've already, when you look at the long section, which is basically expressing the mineralization towards depth along strike, you can see, looking west, that 540,000 ounces are already outlined near surface. Our 2025 drilling will expand this resource further, and of course, our deep drilling will also do the same thing. Why buying Goldterra? It's because of its potential. We're not drilling in the boonies, we're drilling in town. The drilling is much cheaper, and at the same time, the potential is greater. And the focus on high-grade mineralization is there. For example, our first hole drill in 2023 intersected the Campbell Shear as planned. And now, we're basically planning to start our wedging program in January after raising the money to drill the first 2 wedge that will be done in early 2025. It's going to take about 5 to 6 months to do those 2 wedges. And we foresee that we'll be able to intersect gold mineralization. And just to show you what type of gold mineralization we're after, this is the most deepest stope in the mine that was partly mined when they shut it down in 2003. So there's gold left there. And the grade can be as high as 20 grams over 7 meters, and incredibly in a jewelry pocket, 534 gram gold over 20 meters. When you look at the old log, it's 3 kilograms of gold over 3 meters. That's what we call a jewelry pocket. They do happen in high-grade gold deposit like the Con Mine. Don't forget, beyond the Con Mine, we also have the asset that covers 50 miles of the Campbell Shear. So you can for sure see the importance of the camp. And of course, our goal eventually is to produce gold and be one of those mid-tier producer based out of Canada in a safe jurisdiction. Thank you very much for your time.
Now we're going to something very different in the biotech space. This is a company we've traded a few times and made some money. One of the things we like in biotech is when a company is, first of all, 90% down. Because if there's good news, you get a double or 4 times on the stock, and then you can take your original investment off and hold the rest. Now, this particular company has a lot of very good products, but they made a very serious mistake. If you look at this chart, by the way, we think that chart will fill in the gap for those of you that are technicians. They did a 60-for-1 reverse. They would, under $1, they had to go over it. We had recommended 10 to 20, because once you go over 10 times, you anger your current shareholder base, and they just walk away. But for those of you that are coming in, or those of you that played it and made some money, you don't have to worry. That's done with. It's undervalued and has good products, and therefore we think there's a good opportunity to go 2 to 4 times.
Hi there, my name is Lisa Conti. I'm the founder, president, CEO of Jaguar Health. We're a public company. You can learn more about us at jaguar.health, and I will dispense with the forward-looking statements. I'd like to entitle this presentation, The 3 Catalysts. In fact, the 3 near-term catalysts. To level set, we're a commercial-stage pharmaceutical company, plant-based medicines, particularly to treat gastrointestinal orders. These are prescription products. Catalyst number 1. At the recently conducted San Antonio Breast Cancer Symposium in December of this year, we presented statistically significant results for breast cancer patients. This was a prospectively defined subgroup looking at the prophylaxis of diarrhea in patients on targeted therapy with or without cytotoxic chemotherapy. What is targeted therapy? These are the more than 50 agents that are out there that allow metastatic patients to live with a chronic cancer situation 5, 10, 15 years. they'll be on these targeted therapies for the rest of their lives, and even in a curative situation for a couple of years. The type of diarrhea we're talking about can be as much as 40 loose, watery stools a day. This not only affects comfort, dignity, quality of life for the patient, but more than 40% of the time they go off their life-extending, life-saving therapy because of the side effect of diarrhea. You can see in yellow here some of the rates of diarrhea that were presented in some of the clinical trials at this conference. This, to Jaguar, is an opportunity for business development collaborations with some of the manufacturers of these billion-dollar franchises to bring in non-dilutive dollars to Jaguar. Catalyst number 2, crofelemer for the orphaned indications of intestinal failure with short bowel syndrome and a congenital diarrheal disease. We have 5 important catalysts in December of 2024, January of 2025, 3 investigator-initiated proof-of-concept studies, 2 phase 2 studies. With proof-of-concept and phase 2 data in Europe, there is an opportunity for reimbursed early patient access revenue generating before the product is fully approved, a program that does not exist in the United States. These are patients who are on parenteral nutrition up to 20 hours a day, 7 days a week. High morbidity, high mortality, high expense, high patient family involvement, no quality of life. Third parties put this market between $5 and $12 billion. We expect to have proof of concept in the first half of 2025. And catalyst number 3, we launched in October of 2024 our first commercial footprint into cancer-supported care, Gelclair, for mucositis, the most noxious side effect associated with chemotherapy. You'll see the financial impact in the financial results that we release in 2025 for the first time. Finally, the undervalued opportunity of the company. When we did our cancer trial, it was a big hug to the entire cancer community. We included all solid tumors, 24 different targeted therapies, and we paid a price for that diversity, which led to variability. And on July 23rd, we announced that we did not achieve the primary endpoint. However, we build back from here with a prospectively defined subgroup of breast cancer patients, which was close to 70% of the patients. We achieved statistical significance. Finally, I do want to say, if you're a patient in the United States with cancer and diarrhea, you can get a prescription for crofelemer if you're a dog on label. If you're a human, not yet. Please go to our website and look at the opportunities that we have for investment highlights, jaguar.health, and thank you very much for listening. Have a good 2025. We intend to.
Okay, got a little bit more before we get to Q&A. First, I've always liked the high-risk, high-reward parts of portfolio. So we have 5 companies that we think you could take a look at in the healthcare space. Can-Fite Biopharma, Cellsci, which is a company that we've known for many years, BioRestore Therapies, Jaguar Health, which you just saw, and Milestone Scientific. All of these have some catalysts in the next year. Again, high risk, high reward, but I think there's a high probability that at least 2 to 3 of these will do a double plus, which means if you buy them as a sector, you should make money. Whether you take money on the first double or triple, we generally recommend doing that. Then you can ride the rest. So there are 5 that you might want to take a look at. Now, if there's a recession, and there are in some parts of the world, and if things look bad, which they don't seem to be at the moment, then we're of the view, be greedy when others are fearful. We're not seeing that yet. We expect to see it within the next 18 months, certainly in certain parts of the world. One of the areas we like is media and entertainment, along with gold. However, this we're going to be buying not now, but when we get closer to recession, when they start talking about recession-like, because the risk-reward is not as appropriate. But the 3 we're looking at the moment, and these numbers change, is Lionsgate, National Sin Media, and Sony. So when you start to see the recession issues, are we in a recession, are we going into recession, is it not a soft landing, then these are stocks you want to own. So what are our strategies? We have 5 strategies. Number 1, we want to be prepared for both inflation and deflation, although I think we're putting a little less emphasis on inflation and a little more emphasis on deflation. That is to say, so we like gold, cash, hard assets for the inflation. We like blue chip stocks that benefit from inflation. That is to say, they have to have pricing power and profitability, as well as companies that will survive and prosper in a recessionary environment, because we think that's coming. Okay, that's number 1. Some real estate and REITs, although it's a little bit early for this, think not 2008, but patience is a virtue, and remember, if you choose wrong, there are going to be a lot of losers as a lot as winners. We're going to be talking about this probably in the March, if not the August time frame. Now, this is the tricky part. There will be bankruptcies and restructuring. Watch out for heavily indebted companies, especially in the small and micro cap space, which is what we like. So right now, everything's looking rosy, again, because of the president. I think they'll be a lot better than they would have been otherwise, but there will be bankruptcies, and you've got to be careful with them, unless you're a short player, in which case you're happy. So here's a list of 8 defensive plays that we like companies. First, you could buy the Dividend Aristocrat, which doesn't have as much upside, but much less downside, because they're giving you constantly upgraded dividends. We have a company that we've liked very much, Acme United, which will be presenting for us in February, and they're being repositioned from a pure manufacturing play into primarily a healthcare play with very, very good profitability. American Water Works, because as you know, water, you've got to have it along with food. Easy Corp is a very interesting pawnbrokers, and I used to think that basically pawnbrokers made sense because if times were bad, people would use it. But when I went to their presentation, I learned something different. He said, no, we make money good times and bad. In good times, there are many people who go to pawnbrokers to buy what has been left at the pawnbrokers, and of course in bad times they don't. He said the only time we didn't really do well was during COVID. I said, why was that? He said, because everyone got their money from the government. They didn't need to go to pawnbrokers. But this is something that's good. It makes money good times and bad. General Digital is our play. I like Norton. And clearly, computer security is becoming more and more serious. One of our clients recently just got one of those threats for giving Bitcoin, and they just messed up his computer system, which is why always have backups and be encrypted in the cloud. But General Digital, self-storage, because they do well. And, of course, waste management, because there's plenty of it. So those are 8 companies you can take a look at if you want to be defensive. And I'm not saying be totally defensive, because there's going to be upside as well. These are 8 choices that I think you should take a look at. Strategy 2 is distressed investing. We haven't seen enough of it. You've got some of it in the real estate market, but there's going to be more coming. We like it when things fall out of bed, whether it be biotechs or whether it be real estate. Alt assets, venture capital, real estate, private equity, commodities, and private debt. But you should be careful. Dealing with hedge funds, CTAs, and private equity ETFs have a lot of risk. So it's better to be safe than sorry. It's just something we're doing. You may or may not want to join us, or just put a small amount in. 3, day trading and long-short pairs. If you track us a little bit on Twitter or client positions, we like to go at the 2nd and 3rd level of either a buy or sell. That is the 2nd or 3rd resistance level, and be contrarian there. If there's profits or losses, we take them daily or overnight for the next day, because especially now, if you see how much money we made on the 17th and 18th December, and a lot of it went away. So you have to take at least half of it, and sometimes all, depending on what the markets are doing, because right now they're still being supported. We always want to know where the exits are, and unlike some people, we like only trading in directions of fundamental value. Obviously, if you're a computer, obviously, if you're not emotional, you can trade long or short the same instrument. I prefer to trade because sometimes we do take trades and turn them into investments. If we're in the direction and it's deeply discounted, then I'm not comfortable with it. And of course, 52-week high and lows depending on whether buying and selling, which is one of the things we recommended, although we ourselves didn't do it. There were a number of trades recently on the 52-week highs. Favorite sectors, we have a bunch of them. Distressed investing, AI, quantum, but quantum I think is way overdone. Most of those won't be profitable for 2 years. Space technology I think will be hot. Drones and robotics, very hot. And robotics especially because of as more and more labor costs are going up close to 10% a year if you've got a good union, some of those jobs are going to be sent to robots, whether it be cleaning windows and robots cleaners to other things. So drones and robotics, very hot area. Natural resources, yes. Safety, security, and defense, I don't play it so much, but clearly those will do well. Gold, entertainment, which were depression favorites. Digitalization, no-brainer. Energy and industrials, again, no-brainers. Art and blue chips, if you've got the money, it's a place to play. And always special situations that we like. And there'll be a lot of them in the next 2 years. So 4 energy companies we like, and one of the things we want is good management and 5% dividends. 4 of them: Diamondback Energy, Energy Transfer, Surge Energy, and Riley Exploration Permian, which I believe will be presenting for us in April. Very undervalued play. The big plays we look at, but they're giving less than 5%, but they'll do much better with the new administration. But if you want something with a little bit more kick, here are 4 of them. And we always like to say, I don't do the wine investing, I like to drink wine, but if I was, I'd be old-fashioned. And what they used to do is you buy 2 bottles, you wait till the price doubles, you sell one and drink the other. What a way to play. I mean, to me, that's ideal. As for art, I'm not really an art person, but you should, I believe, unless you're very knowledgeable, you buy it because you love it, not because it will make you rich. But, you know, if you buy blue chip art, the odds are it will go up. So our 5th thing is to be cat-like. We have 2 cats. Oh, I should actually give pictures of my cats next time. Next time we'll put in our cats. We accumulate buy on weakness, our favorite stocks and commodities. Everything I've given you is too much to buy. Generally, 20 to 25 stocks is enough for a portfolio. We watch them. When the news comes that we like, we get involved. Now, our desert island pick is a very interesting point. At a certain point, basically, the stock was up 70%. Now, we were on a desert island, so we didn't know about it. But if you were trading it, you might have wanted to take a little bit off the table, because if you look at it at the end of the year now, it's did well. It's up 30%. It's basically equal to the S&Ps. I think next year it's going to do much better. This is a winner for us. We're going to play it for you before we go into a couple of more points. But this is a core holding for us. Excellent management. What we haven't seen yet, and what we're expecting, is some discoveries, which we thought we'd get it at the end of this year, but we'll probably get it next year. So we have targets that is certainly well over 50% from where they are now, and we're just simply holding it, trading a little bit of it, but mostly holding it.
Good morning, everybody, and welcome to Mag Silver. be making some forward-looking statements today. I draw your attention to those. So MAG, we're a high-value, high-margin, Tier 1 silver producer. We're well-positioned for continued shareholder value creation. You see here on the map, our flagship is the Juanicipio mine in Mexico, a joint venture with Fresnillo PLC, who are the operator. We own 44% interest in that operation. We have the Deer Trail exploration property in Utah, the Larder exploration property in Ontario. We're currently sitting at the end of the third quarter with $113 million in cash. We have no debt, and we are one of the lowest ASIC producers on the planet. Our model is building a high-margin, sustainable cash-flowing business. Production from Juanicipio, exploration success at the Juanicipio property itself, as well as Deer Trail and Larder, equals value creation for shareholders. Lots of conversations about the silver market. Now, what really drives it is this deficit, year on year, increasing deficits, demand's increasing, particularly on the photovoltaic side, not a great increase in supply, and warehouses, inventories decreasing, so things are looking good for the silver price. We'll go down to Juanicipio. You can see here on the map, it's that red. There's the joint venture ground on the Fresnillo silver trend, the most prolific silver district in the world. We are a silver mine in the call-outs, 85% precious, 75% silver. We've got a very high-grade mine, and during the course of 2024, we've had to increase our guidance from 380 to 420 grams per tonne of silver up to 420 to 460 grams per tonne. And we're saying, we're guiding towards we'll be at the top end of that. And what really makes our story different is that last call out on the ASICs, $4.57 year to date, $3.28 per ounce of silver produced in Q3. So wonderful margin, and you can see it here as the plant has started up the first quarter of last year. You see the blue bar starting to flatten out into steady state operation. You can see the ASIC falling in the green curve here, and the ASIC margin increasing, $120 million of ASIC margin last quarter. What makes it unique is the red arrow. Our deposit is sitting on the source of metals that came up and mineralize a significant portion of the most endowed silver district in the world. This shows our mine plan in the blue, as per our technical report that we released in March of this year. 13-year reserve mine life, but if you look at the table, there's at least another 13 or more years of inferred resource life, and we have a real high conversion of resources to reserves. Here you see the grade. The silver grade does diminish with time, but it's offset by increasing base metal grades, and so our silver equivalent grade's pretty flat through the whole year, and that gives us pretty robust cash flows for the life of the mine. And the real story here, it's a great asset. It's making a lot of cash, great margin, but we've only explored 5% of the property, and there's very compelling reasons why there could be more of these red assets on the red arrows on the property. Going up to Deer Trail, great address. We're sitting on the same trend as Bingham Canyon. We're looking for a porphyry hub, silver-rich spoke model here. We're well advanced on drill programs, and we'll update the market on that early next year. Then quickly up to Ontario. The Larder property that we have is very nicely positioned for a location story, sitting on the Cadillac Larder break, but also many other second and third order structures. And this is a gold driven at the moment. We've had some success with the drill, and we again will update the market on that in early 2025. So our evolution from explorer to a successful producer underscores our drive to cash flow and growth. The balance sheet's in fantastic shape, and we're adding to that. And discoveries anytime at all three properties. Thank you for your time. I refer you to www.magsilver.com if you'd like more information. And if you really want to drill in, our technical report filed in March of this year. Goodbye, everybody, and thank you.
Okay, now here's something put in. These are 5 companies. We're not on our buy list yet. Well, actually, one is, but that could be real home runs, more than 4 baggers. So we just want to throw it out. We're going to deal with this probably in detail in our March 20th one. The first is BioHarvest Science, which is something I was just trying their coffee today. What they do is, if you like to drink wine, which I do, and you like Revysol, they basically have pills that basically are equivalent of about 70 of these. So in order to have all the benefits of wine, some people say you have to drink 10, 20 glasses a day, but if you do that, you have some negatives. This is a very, very interesting product. We're still doing due diligence on it, but if it is what it promises, it's a giant win. Rare earths are important. One of the ones we like that we looked at is Brazilian rare earths, which has, on first sight, tremendous potential. Again, we haven't finished all due diligence, but extremely interesting. Perfect Corp is an excellent AI play, not only in cosmetics, etc. Now, for example, if you go online and you want to see what you look like in different glasses, etc., you're probably using their software. It's a company that's going to be in a hockey stick as well. The metals companies we've dealt with before, that's undersea mining. We believe that will be in the second half of the year, that the UN will give its go-ahead, at which point the stock will more than triple as well. And then antimony, which as we know has gone up thanks to the Chinese, way up. I do believe that there'll be a settlement this year. But even so, with this, assuming that antimony drops in half, it's still a major play as the major domestic manufacturer. But all of these, there are issues involved, potentially nothing negative. It's just there are things that you have to work on. But it's 5 that you may want to watch if you're looking for a real home run grand slam. I'm not saying all 5 of these are, which is we're not recommending them yet, but we'll have done that and completed it by March. So some rounding up. We believe there'll be physical and economic challenges in 2025. We don't buy the soft landing thing. We suggest caution. Most important, have money to buy either cash or margin if markets panic, but if they go down 20, 30%, how much margin are you going to have? Be careful. Just certainly can happen. There are winners and losers, although index funds did very well. Traders paradise, absolutely. You can work probably 5 days a week, and actually 5 days a year, and be done with it. Again, a long investing horizon, at least 2 years, versus intraday or even 10 minutes. Sometimes, I feel like getting out by the 8:30 news, and since I'm a futures trader, take my 50, 100 points and say thank you very much. I don't, but I probably should. So let's see if there are any questions to deal with at the moment. I don't think there were earlier. Nope. Most people didn't. We'll give it a moment or two if people want to add any 1 or 2 questions. I think I've given you a lot of material. Clearly, you may want to review this. I'll probably have it up on Sunday. I was asked about the eclipses. Eclipses represent dramatic changes. They can be for good or bad. It really depends on what the circumstances are. It's for 2026. It will be affecting Russia. This year's eclipses, I was not that concerned with myself. They may have some value. You have to do an astrocartography for them. The big one, I was interested in the one last year, and that basically was one of the reasons we were bullish and didn't sell in May and go away. The one in 26, which has a lot to do with Russia, we'll be dealing with later. The ones this year, they have value, of course, but they don't concern me particularly. I'm interested much more in the Jupiter-Saturn. I'm interested in the Saturn-Neptune. Those are the big players that you got to concentrate on, as far as I'm concerned. Okay, well, I hope you all enjoyed it. We put a lot into here. Our next one is going to be March 20th. You're all welcome to attend. We'll be giving updates, a little specifics on a few of the companies. It will be shorter than this because this is the basic material we'll be running all year. Again, the bottom line is we are expecting recession-like environment. We think it can be dealt with. The debt is going to have to be dealt with. And at some point between the next 18 months, the markets will correct. So thank you very much for attending, and I appreciate you being here.